Good morning, John. It's good to see you. We're recording this on Thursday, the 22nd of February, and Wall Street's just closed. And I noticed that NVIDIA's just recorded its fourth quarter results. Very, very strong result, and the stock is actually trading up about 8% in after-hours trading. John, we seem to be bumping our heads up against record highs, and this is in the United States, and it's in Australia as well. And a lot of people are a little bit nervous that perhaps markets are priced for perfection. What are your thoughts on that?
Well, if you look at the history of stock markets, they always reach record highs. I think it's folly to say, oh, the market's at a record high, so it's got to fall back. I know markets go up and down, but they have a trend line which always goes up, and we always reach new highs. The question is, does it happen over 12 months or 2 years or over 10 years? And we know the Australian market, the index, not the accumulation index, the price index took quite a while to get back to its pre-GFC highs. The American market has been reaching new highs consistently on a much less time span. That's normal. When an economy is growing, and the profits of companies who are listed on the stock market are growing, and the value of those companies obviously increase, markets will reach new highs. The issue is the market fair value? Are we in some sort of bubble? I think in mainstream journalism, they look at new highs as being a bubble because they don't understand economic growth, profit, and valuation. In terms of what we're trying to tell clients, it's quite clearly that the American economy is doing much better than expected. There was a catch-up rally. Now it's surging a little bit more. The S&P 500, which is the most relevant index for a broad index, breached 5,000. It's pulled back a little bit now. But people got to reflect. 2 years ago, we had so-called experts telling you the market was going to be 2,500. So they look silly. I maintain, parts of the market are always frothy. Some parts of the market are always good value. Most of the market's fair value. It's just we're going upstairs, and markets anticipate, and markets get surprised. I look at the relationship between bonds and equities. I've written this in LinkedIn if people want to look at that article. The bond market, 10-year bonds in America, 4% and a bit. That's supportive of equity markets when the economy is growing 2.5% to 3%. And profits, and you've just mentioned NVIDIA, there are some outstanding profit results coming from major US multinationals. And if they have outstanding results and have growth, then all things being equal, their share price and their value will go up. Whether they're great buying at any point in time is a different question.
Yeah, it's interesting just mentioning NVIDIA because even though the focus on AI has put a lot of attention on NVIDIA, and the market had great expectations. It went and exceeded those expectations. In the last quarter, it had revenue of $22 billion ahead of expectations of $20 billion. The share price has gone from basically $200 a year ago to $700. Do you think that there's a lot of focus on the Magnificent Seven, these 7 mega cap tech stocks, but it's very different to what we experienced back in the day in 2000 with the tech bubble, don't you think?
So, go back 20 odd years, we were anticipating across a broad market with, really hundreds of companies entering the e-commerce or the internet and, that sort of the NASDAQ sort of technology indices. They were emerging from the middle 1990s, through to 2000, and we had that extreme bubble where speculation overtook logic. And the speculation element is very much about the market anticipating that a whole lot of companies which had no track record, were not profitable, were worth something. This time around, companies, the multinational, you look at the top 7 companies, the performance that they've transitioned from being early stage speculative investments to now sustainable businesses who are multinational brand names selling products across the world, it's a completely different situation when you think about it. I'm not saying in the background and in the middle or smaller end of the NASDAQ there may be speculation, But that's also driven by the fact you've got successful large companies who may be looking to bolt on, technology companies sitting below the surface, and so they get bubbled up in price. So to your point, much different cycle. Businesses, these multinational companies are making money. People can make their own assessment where they want to buy them at certain times, but if you take a long-term view and the technology is fantastic and they're generating cash and they're reinvesting in their business and sustaining their longevity, then they become viable long-term investments. It's just a matter of when you buy them. But if the more successful the top companies are, Paul, it feeds down to all the feeder companies, the suppliers and the service companies. It's great for the American economy, successful companies, and we shouldn't be sitting back being scared by success. It's sort of an Australian trait. We don't like success. We question it. America has get on board sort of attitude, and that's why they're a successful economy.
Just turning to valuation, if you look at the S&P 500, which is the benchmark index, as you mentioned, it's on a PE of around 20. If you take out those top tech, the Magnificent Seven, so-called, the rest of the market's on about 16, which is the long-term average. If we have a look at Australia's PE, the long-term average is about 14.5. Perhaps it's sitting a bit higher than that. So clearly the earnings are critically important. We're now at the beginning or towards the middle of the earnings season. What are you looking out for? What are you seeing? And are the earnings justifying the prices?
Well, there's very few disappointments, and I know Will Riggle will be back in a couple of weeks to wrap up the total reporting season. But when we discussed last week, more companies are performing well than performing poorly. So, the Australian corporate sector is well run. It's well financed. It's well capitalised. There's not a lot of debt. Those fronting the consumer, some companies have struggled a bit, but the outlook is pretty good for them, and the markets are buying outlooks. We've got to be very careful about people looking backwards 12 months and valuing stocks today. That's not how you value stocks. And I think the outlook looks continually improving. We're seeing the tax cuts coming through shortly. That'll be a good for the market. And I think a lot of companies are saying, look, we've gone through a fairly tough period, but from the consumer end, it's going to get better. From the tourism end, it's going to get better. Tax cuts are going to sustain growth. Population growth going to sustain growth. And that's why the market is sort of bouncing. Whether the results are really good or just average, the fund managers are looking at the outlook statements and assessing it against a macro background, which looks fairly positive. So to answer your question, we haven't seen many disappointing results. Most of them are as expected, a few slightly better. But encouragingly, the dividend flows coming into the market are quite strong. And from an investment perspective, and particularly our investors, mainly pension investors, that dividend flow is very good from our LIC. Our LIC is getting very good dividends, client capital, which gives us confidence in our dividends. So, I think reporting season's been quite good.
Well, let's focus a little bit on yield for a sec. So part of the prevailing narrative that drove the market over the last 3 months was that inflation was coming down faster than expected, allowing central banks to ease off the highs, and that was going to happen sooner rather than later. Now, I think particularly after a January CPI number out of the US, the narrative has shifted to be a bit more conservative, and they're now saying that central banks are very concerned not to take the foot off the brake too soon. And so instead of the market expecting the Fed funds rate to fall in March or April, now the market is expecting perhaps it only happens in June. And instead of there being perhaps 6 rate cuts over the next 12 months, perhaps there'll only be 3 or 4. What are your views about the Australian outlook? I know you've said that the RBA won't cut before the Fed. So do you still see a greater probability next move in rates is down, and therefore, we should be looking at the high yielding stocks, the dividends, as you say, franking credits and so on, to make those longer term investment decisions?
Yeah, look, just compare the two yield curves between America and Australia. So cash rates America, 5.25 to 5.5 cash rate, 10-year bond 4.2. So cash rates 1% above. And also cash rates in America 2% above inflation. Go to Australia, cash rates 4.35, 10-year bond 4.1. Goes the other way. It's a slight, so not the other way. It's going down slightly from cash rates to 10-year bond. Just look at that. Look at the relative inflation. Australian interest rates are not that high. American short-term rates are very high based on inflation. American interest rates stand out. If we ignore New Zealand and some other small parts of the world, I guess Canada's cutting now. But most of the world is well below the cash rates of America, including Australia, because they've all got different issues to address. And mainly it's around debt. And we've talked about this ad nauseum. Australia's debt is centred mainly around the household sector, and they're very highly encumbered against property. The rest of the world, Europe, is very high government debt. And behind the scenes, the central bank must be watching the interest rates on bonds, the yield on bonds, because it's becoming a major issue for their governments in terms of servicing debt, and then that leads into quantitative easing and quantitative tightening. Now I think there's a lot of strange statements coming out of central banks because they actually don't want to tell the people that they've got a major problem, or their governments have a major problem in funding their debt. That's not the case in Australia. Our issue is the property market and the price of property and the serviceability of debt against property and the rental costs of renting property. We've managed to create an almighty problem, which is very hard for the central bank to deal with without government assistance, and hopefully one day they'll get together and talk. But in terms of interest rates, I maintain that Australia's interest rates aren't that high. We can't possibly cut. There's still some wild statements said, there might be one more increase. I can't think of a reason why, except this one, that the Australian dollar remains very weak against what I regard as fair value, and that's bringing in imported inflation. So that's the only justification for putting interest rates up, to try and get the Aussie dollar up, to get another leg down on inflation from imports. Now we do have the Chinese situation where they look like they're having deflation at present. Yeah, and we could become a devaluation from China at some point. So I just watch this weekly, and we talk about it weekly. Paul, has anything happened the last week to worry me? Nothing. I just think it's a waiting game, and people need to talk constantly or daily about interest rates, and journalists need to write stuff and fill up the paper. But I think, honestly, a lot of us can go and play golf and not worry about it. It's really nonsense.
Yeah. John, we've probably got time for just one last question. You alluded to the stage 3 tax cuts. Obviously, that's coming through and will boost a bit of... but there is a bit of chatter now, particularly within the Labour left and the Greens, about perhaps doing away with negative gearing as the next big so-called reform. And that links in with your comments about property prices. Do you have a view whether that's realistic, or whether there's any chance of that happening, or what the impact would be?
Well, it's a constant perennial tax debate around negative gearing. Those who utilise it will die before they give it up, and those who don't utilise it go, why are we giving benefits like that to people to invest, to offset other income against interest costs on a negative yielding investment? I mean, we create these situations, and the political situation in Australia, where the Parliament debates ad nauseum from perverse positions, always black and white, rather than going to an independent body, think tanks, and asking them for the recommendations. Now, I know people say we had the Henry report and there's 140 or whatever recommendations, only about 5 have been picked up on. But all the things we're canvassing were canvassed in that report, and it was ignored. I think there's a report, Ken Henry did an interview this week, and it's going to be reported on First Links. So I keep on talking to people and saying that you should be reading First Links. It's a very good interview with Ken Henry. And he says, well, negative gearing should go, and he gives all the reasons why it should. The bigger issue is the whole tax system is so rotten. The way Australia, much better, and I was just thinking this coming in on the ferry, reading the Ken Henry interview, if we could only get an agreement, how much tax as a percentage of GDP do we want to raise? Is the number 24, 25, 26? Once you land on that number, then the next thing you do is ensure that the expenditure is around the same level, if not lower, and only higher if you need stimulation. And then you say, well, if it's 25% tax, then how do we break up the components to get to 25%? What we're seeing is an excessive reliance on income tax, which means that the income tax debate is always front of mind. In the background, we've got a whole lot of other strange taxes, GST, Henry would say the lowest in the world, negative gearing, not really, Australia quite unique, half capital gains tax, no property tax, a strangely constructed superannuation system based around accounts, with a fallback to a Commonwealth pension.
Franking credit.
Yeah, franking credits. I mean, the whole thing is a hodgepodge because governments change the law to get elected rather than thinking about the big picture. And we still have people protecting their positions. I talked about the future fund and the beneficiaries. You've got a whole lot of bureaucrats and some still politicians who are protecting their benefits, which are sitting in defined benefits. And so, issues about changing the defined benefits, taxing them appropriately, consistently with superannuation, they're never addressed. The whole superannuation system where we have Commonwealth pension, a house, and account-based superannuation system, that's supposed to be the superannuation system of Australia, the pension system, and yet we tax them all differently. Yet they're all part of the same scheme. So my comment, Paul, is it's a mess. I think the politicians in their world like it to be a mess because they can just talk about something and go nowhere. I don't think the Greens' suggestions are very useful because they're very limited. They don't encapsulate the whole problem. The whole problem needs an encapsulation, but we are going so far down that everything we want to do is you've got to grandfather inefficient taxes. You've got to grandfather all this nonsense, and until we get a major recession and the grandfathering goes, I mean, we're stuck with so many issues that they're becoming insurmountable, which is so my view is just accept there's not going to be much change, carry on. When the baby boomers die, the next generation will be their problem how to fix it up. They won't have to look after our legacy.
Well, on that cheerful note, we'll have to end it there. Thanks, John. Until next week, stay safe and we'll see. Cheers, John. Thank you.
All right. Bye.